Welcome to the debate. If you place your hand on a hot stove, your nervous system doesn't ask for permission to pull it away.
Right, it's totally automatic.
Exactly. The pain signal fires, your reflexes take over, and your hand just jerks back. It's a brilliant biological survival mechanism.
Yeah, it keeps you alive. And it's entirely outside of your conscious control.
Right. But when you step into the financial markets, that exact same biological survival mechanism, the instinct to recoil from pain and cling to safety, it turns into your greatest liability. So today we're looking at the intersection of human psychology, cognitive execution, and financial market performance.
And we're going to connect the dots across empirical data spanning millions of trades, along with functional brain imaging of professional traders and the broader behavioral finance literature.
Yeah, the central question we're debating is this. Does achieving lasting market success require traders to master and, suppress their natural emotional responses? Or does overcoming innate market biases demand rigid analytical frameworks that emotional dampening might actually hinder?
Right.
I'll be arguing that mastering emotional control and physically adapting the brain to suppress fear responses is the ultimate key to beating our own biases.
And I'll be taking the opposing view. I contend that emotional dampening can actually impair market timing. So success relies on structural rules and cognitive action rather than emotional regulation. Relying on emotional control is, it's an incomplete and potentially hazardous strategy.
Okay, let me lay out my perspective first. The market is inherently irrational. It's driven by fear and greed. Think of Benjamin Graham's classic Mr. Market concept.
Right, the manic-depressive partner.
Exactly, offering you prices based on emotional whims rather than actual value. Human beings are biologically wired to fail in this environment because of phenomenon like loss aversion and the disposition effect. We feel the pain of a financial loss far more acutely than the pleasure of a comparable gain.
We do.
But empirical data from fMRI studies shows that professional traders physically adapt to overcome this. They dampen their emotional centers, specifically the amygdala, which is basically the brain's fear alarm, while heightening cognitive control in the dorsolateral prefrontal cortex.
The planning center?
Right. Because they can biologically mute the panic response, they can prioritize analytical processing. Therefore, neurological emotional control is the primary driver of consistent returns over time.
I come at it from a completely different way. Framing trading simply as an emotional control problem ignores the mechanics of how humans actually process complex information.
How so?
Well, emotional dampening can lead to delayed, costly reactions. There's compelling evidence showing that sustained mindfulness training, which aims to reduce emotional reactivity, actually causes traders to underperform by over 35% following negative news.
Wait, over 35%?
Yes. Overcoming the disposition effect requires systemic cognitive frameworks, like mental accounting adjustments and automated trading rules, not just achieving some tranquil emotional state. You don't beat the market by numbing your emotions. You beat it by building a system that executes flawlessly when your cognitive biases threaten to take over.
Well, let's actually talk about why we fail before we argue about the solution. The disposition effect is the classic trap, right?
Right.
It's the tendency of investors to hold losing positions way too long and sell winning positions way too early. When we look at the data, specifically an analysis of 28.5 million trades across over 80,000 traders, retail traders consistently demonstrate a terrible win-loss duration ratio. They hold on to their losers far longer than their winners simply because they fear realizing a loss.
Because realizing a loss means admitting defeat.
Exactly. Think of realizing a financial loss like ripping off a bandage. The brain's amygdala screams in anticipation of the pain. To execute the trade rationally, the professional brain must learn to mute that scream entirely. Author Leroy Gross calls it get-even-itis, that desperate desire to just hold on until the stock bounces back to break even.
Just to avoid recognizing the loss.
Right. Curing that requires severe emotional detachment.
I'm sorry, but I just don't buy that it's all about muting a scream. If it was just this unyielding, primitive fear response, we'd see it constantly. But Schifrin and Statman, who pioneered the study of the disposition effect, identified it as a combination of prospect theory, mental accounting, regret avoidance, and self-control. It's not just raw fear.
But how is regret avoidance any different from fear? It sounds like two ways of describing the exact same aversion to pain.
Because regret avoidance involves how you categorize the event in your head. Look at the mechanics of mental accounting. The pain of regret is generated specifically when a mental account is closed.
Okay.
As long as you hold the stock, it's a paper loss. It feels hypothetical. You haven't lost the money, the market is just temporarily undervaluing your asset. Closing that mental account turns it into a realized loss. That's a cognitive framing issue, not a biological reflex.
Which is exactly why the emotional aversion to closing that account must be suppressed.
But we know it isn't just about suppressing emotion. Look at the phenomenon of tax loss selling in December. Every December, the disposition effect reverses. Investors suddenly sell their losers at a rapid rate. Why?
Well, the tax break.
Exactly, because the cognitive framing has changed. They're now looking at tax benefits. The mental account transitions from admitting a painful failure to executing a savvy tax strategy. This proves the issue is driven by cognitive framing and mental accounting. If it was just raw emotional fear of loss, December wouldn't magically cure it.
I see why you think that. But let me give you a different perspective. I'd argue the December reversal actually proves my point.
How?
The external incentive of a tax break is the only thing powerful enough to override the amygdala's aversion to realizing the loss. It's an artificial incentive. The rest of the year, without that external structural nudge, the raw emotion governs the behavior. We can't rely on tax season to make rational trades the other 11 months of the year.
Sure.
That's exactly why professional neuroplasticity is so vital. You have to train your brain to act like it's December all year round.
But neuroplasticity isn't the only way to reframe a decision. You can use hedonic framing or automated rules to change the mental accounting without requiring a trader to physically alter their brain chemistry.
Okay, let's explore that brain chemistry because the fMRI data of professional stock traders is quite remarkable. When professionals make high-risk decisions, the neuroimaging shows suppressed amygdala activity and heightened activation in the dorsolateral prefrontal cortex, or DLPFC.
Right.
For anyone unfamiliar, think of the brain like a corporate hierarchy. The amygdala is your frantic security guard. It pulls the fire alarm when there's danger. The DLPFC is the calm CEO looking at the security cameras to verify if there's actually a fire. What happens in pros is a structural adaptation. Repeated exposure to risk allows the brain to literally turn down the volume on the security guard.
So the CEO can work.
Exactly, to prioritize the CEO's analytical processing. They've rewired the hot stove reflex.
And what happens when they do that?
By dampening the fear response, the professional can evaluate the subjective value of a trade in another area, the ventromedial prefrontal cortex, which acts as the accounting department, without the interference of panic. The accounting department needs a quiet room to weigh risk and reward accurately.
You're assuming that turning down the volume on emotion is always beneficial. It isn't. We have to look at the European Financial Management Association study on trained mindfulness in trading.
Okay.
They conducted a randomized controlled experiment with traders who underwent sustained mindfulness training. These mindful traders practice paying attention to the present moment without conceptual elaboration or emotional reactivity.
Wait, hold on. Being mindful actually made them lose money? That goes against practically everything we hear about trading psychology. How exactly did that happen?
Say otherwise. These mindful traders underperformed control groups in low uncertainty, high information load scenarios. Specifically, their lack of emotional reactivity caused a costly delay following negative news.
Oh, wow.
Yeah, because mindfulness attenuates negative thoughts. These traders didn't react fast enough when the market turned against them, resulting in a 35.4% underperformance. Let's paint the picture here. Imagine a trader watching a stock plummet on their screen. Because they've trained themselves to be totally unbothered, they sit there observing the red candles instead of frantically clicking sell.
Huh.
Numbing the emotion slowed their reaction time when the market was tanking. Emotion is data. Fear tells you to get out. If you suppress the fear, you miss the signal.
I see the merit in that point, though I would frame it differently. Is there a crucial difference between a mindful pause and professional neuroplasticity?
What do you mean?
Well, the mindful traders in that study are practicing deliberate observation. They see the bad news, they sit with the emotion, they process it without reacting. That deliberate process creates a sluggish delay. But the MRI data on seasoned professionals suggests something entirely different. Their amygdala is suppressed so that the DLPFC can execute faster.
I see. The professional doesn't pause to be mindful. Their brain has automated the emotional suppression to allow for rapid analytical execution. Do you really equate a mindfulness exercise with the neurological adaptation of a veteran trader? That's a fair distinction regarding the mechanism, but the outcome in a high-information flow environment still demands scrutiny. Whether you're pausing to be mindful or your brain is simply not registering the panic, the attenuation of negative emotions specifically impairs market timing.
Well,
And the study showed the underperformance was exclusively tied to bad news. Positive news didn't cause the same drag. This means that reducing your emotional reactivity makes you specifically vulnerable to downward price action because you lack the urgency to sell.
But professionals do sell. They just do it based on analytical triggers rather than panic.
Selling requires a highly taxing mental process. It isn't just about reading a trigger. Research by Akapanatawar and colleagues on institutional investors shows there is a systematic, costly heuristic process involved when selling, but not when buying.
Why is selling so different?
Think about it. Buying is optimistic. You find a stock you like, you imagine the upside, you click buy. Selling forces you to reconcile reality with your expectations. Even the experts struggle to allocate cognitive resources effectively when closing a position. Because of this, the solution has to be structural, not psychological.
Right.
You can't expect a retail trader sitting at home to just magically evolve a suppressed amygdala. And as the mindfulness data shows, emotional dampening can slow them down when it matters most.
So how do you propose overcoming the disposition effect, if not through emotional mastery?
We look at structural solutions like mirror trading. In the analysis of those 28.5 million trades, mirror trades, where an account automatically copies the exact trades of another, have a much higher fraction of positive trades and a better mean return on investment than manual single trades.
Because the computer does it?
Exactly. The structural rule overrides human cognitive bias entirely. With algorithmic tools, expert advisors, or trading bots, you completely remove the human element. The system wins, not the psychological state of the trader. By removing the decision to sell from the human mind, you bypass the regret avoidance and mental accounting traps completely. The machine doesn't care about closing a mental account. It just executes.
I agree that automated systems and stop losses are highly effective. I really do. However, I view them as the ultimate tools of emotional control. They're external mechanisms we use to enforce the rule of ignoring market whims when our internal discipline falters. But let's look at the humans who actually succeed, the ones whose trades are being copied in those mirror trading scenarios.
Okay.
The data reveals that rare winning human traders possess a specific risk-reward ratio profile.
You're referring to the behavioral metrics extracted from the historical trading data?
Precisely. The successful traders operate with a risk-reward ratio greater than 4, a win-loss duration ratio under 100, and a win-loss ROI ratio over 2. Think about what that means for a listener sitting at home making trades on their laptop. To achieve a risk-reward ratio greater than 4, your average profit on winning positions has to be vastly larger than your average loss on losing positions.
Which is incredibly difficult to sustain.
It is. Achieving those exact metrics requires a human mind that has successfully mastered the reflection effect. According to prospect theory, people are typically risk-averse when they have gains and risk-seeking when they have losses. We want to lock in a small profit immediately to feel safe, and we're willing to gamble wildly to make up a loss.
Right, standard behavior.
To hit those winning metrics, a trader must do the exact opposite. They must learn to embrace risk during gains to let profits run and become fiercely risk-averse during losses to cut them short. A system can execute the trade, sure, but a human has to design the parameters. Only a mind that has conquered its own biases can build a winning system.
Designing the system requires analytical clarity. Yes, I won't argue that. But once the system is running, the human mind becomes the bottleneck. The moment a trader intervenes because they feel a setup is different this time, they're falling back into regret avoidance.
Sure, but
Let's go back to the disposition effect and momentum. Greenblatt and Hahn explained how the disposition effect generates momentum in stock price returns. Because investors sell winners early and ride losers, they artificially slow the speed with which prices revert to fundamental value.
which creates market inefficiencies that disciplined traders can exploit.
Exactly. But exploiting that inefficiency requires rapid, rules-based execution. If investors rush to sell stocks on good news, the selling pressure dampens the upward adjustment of price. We call this the capital gains overhang. It's the amount of unrealized profit that investors are sitting on.
Right.
When there's a large overhang, investors are eager to sell to lock in their gains, where it slows down the stock's momentum. If you're relying on your prefrontal cortex to manually calculate the capital gains overhang of a stock while simultaneously suppressing your amygdala, you're wasting cognitive resources.
Ah, I see what you mean.
An automated system recognizes the momentum anomaly and executes without the biological friction. The disposition effect is so pervasive that it costs the average investor between 3.2% and 5.7% in returns. Trying to fight that biological current with sheer neurological willpower is far less effective than building a boat.
Building a boat is a wonderful analogy, but the trader still has to steer it. Even quantitative developers and algorithmic traders face moments of severe drawdown where their systems lose money for months. The decision to leave the system running, to trust the statistical edge rather than pulling the plug out of fear, requires immense emotional control.
That's true.
Algorithms hit edge cases, and when the bot starts losing money, it takes a human with immense discipline not to intervene. The neuroeconomics data proves that expertise modifies cognitive processing. Professional traders show dynamic connectivity among decision-making circuits. The functional coherence between the ventromedial prefrontal cortex, which weighs the risk, the striatum, which processes reward, and the insula, which handles deep bodily emotions, it just starts to communicate seamlessly.
It's an impressive biological feat.
It really is. This isn't just theory, it's biological reality. The brain structurally adapts to the demands of a high-stakes profession.
I don't deny the biological adaptation, but I question its ultimate utility compared to structural frameworks. The fMRI data also shows that stress modulates activity in both the amygdala and prefrontal areas. Fluctuations in hormones like cortisol and testosterone correspond to changes in risk preference and decision speed. You're relying on a biological machine that is constantly affected by sleep, stress, and endocrinology.
No, everyone has a bad day.
But a rules-based framework doesn't have a cortisol spike because it had a bad night's sleep. When we look at the data on traders with high win-loss duration ratios, the losers who hold bad positions forever, they are operating on hope. Hope is an emotion. If you build a framework that forces a sale when a technical parameter is breached, hope is eliminated from the equation entirely.
Let's summarize our positions in light of this discussion. We both agree that human cognitive biases, especially the disposition effect and loss aversion, are severe detriments to financial performance. We agree on the reality that relying on raw human instinct in the markets is unequivocally a losing strategy. The default human brain is simply poorly equipped for financial trading.
We're entirely aligned on that front. Where we diverge is the optimal solution for survival and profitability. I maintain that systemic rules, automated structures, and rapid cognitive frameworks are what actually prevent losses. I view emotional dampening as a liability that can slow reaction times and blind traders to necessary market signals, especially during negative downturns.
And I maintain that neurological and emotional mastery remains the core of trading success. The fMRI data showing amygdala suppression and heightened cognitive control in professionals points to a necessary biological adaptation to the irrationality of the market. You can't automate every aspect of market navigation, and eventually the human mind must evaluate risk.
There is certainly much more to explore within the literature regarding how neuroeconomics and behavioral design will continue to evolve alongside financial markets. Examining our own mental accounting and behavioral heuristics is an ongoing process. I mean, as technology advances, the boundary between human cognitive execution and algorithmic assistance will continue to blur.
And absolutely. The pursuit of optimal decision-making under uncertainty is a constant challenge. It brings us back to that biological reflex, the hand hovering over the heat. The market is that hot stove. Whether you train your mind to withstand the heat without flinching, or you build an automated system to pull your hand away for you, the danger remains the same. Which method will ultimately keep you from getting burned?